Hey everybody, welcome back to the podcast. I'm your host Humza. With me I have Omar. For our newer viewers, Omar is the founder and CEO of Virjee Consulting, which is a dental-focused CPA firm that works with the hundreds of doctors and dentists across the country, minimizing tax liability and growing their practice. He leads a team of CPAs and tax experts that help clients at all stages of their practice. Additionally, Omar is on an advisory board, several companies ranging from 5 million to 60 million in revenue across a diverse industry base. Omar also operates a real estate management and holding company, which acquires, develops, commercial real estate across the Houston market. I'm also excited to introduce our guest, Trey. Trey Zamorano is the founding member of RAZ Law Group, which has been involved over 700 practice transactions, transitions, asset sales, and real estate transactions. He's worked with businesses and practices of a variety of sizes across the country. Prior to launching RAZ Law Group, Trey worked as general counsel for National Healthcare, for mergers and acquisitions advisory firm, and on the national real estate team of a top 50 AM law firm. Trey, we're really excited to have you with us today.
Likewise.
And today we're going to be discussing the topics around purchasing a practice, the importance from a tax perspective, and just from allocating the purchase price as well. We're also going to discuss the importance of your lease agreement and what to look out for that. That being said, Omar, if you want to kind of discuss the current market for purchasing and selling practices.
Yeah, so we work with clients across the country when they're looking to buy a practice, when they're looking at evaluating different practices, see which ones should they buy. Does it make sense? The market has remained very hot despite interest rates, and really what's keeping it hot is the fact that private equity is coming in and buying those practices that are doing $1 million plus in revenue. They have a strong base already, strong infrastructure already, and they're just adding them into their portfolio. So that leaves is the fact that if you're trying to buy a practice that's as a solo dentist or you're trying to add it to your 2-3 practice portfolio that you have, what's kind of left is crumbs, and that's what we're seeing that's doing is it's elevating prices. Or keeping them elevated, even though some of these practices may not, be as strong of an asset, which is why it requires a lot of negotiation, and it's keeping the market very hot because just like in the housing market or in the real estate market, because there's less inventory out there, that's keeping prices elevated despite high interest rates. We're seeing the same thing in the practice market, and the interest rates, despite them being a little bit higher, are still at an attractive point where if you have a well-running practice doing whatever 25% plus EBITDA, even the higher couple points of interest is not going to really deviate your cash flow, and so it gives you a good return on investment. So the dental business itself, the industry itself is still very hot. It's very robust. The change obviously has happened over the last decade, and it continues to get stronger as the private equity is coming in and scooping up those perfectly well-operated practices. That makes it where what's kind of left, if there are good practices out there that aren't selling the private equity, those prices are elevated, and those sellers, it is a seller's market. Yeah. That's kind of what we've seen. Trey, what have you kind of seen on your side? I know you deal with a ton of these.
Yeah, absolutely. Well, thanks again for having me here. Happy to be here sharing our expertise together. I've been seeing different trends that are contrary to what I think a lot of us expected when interest rates began to get high. That hasn't impacted the market as much. Lending remains strong. Yeah. Liquidity is out there. I do agree there's a strong presence with private equity coming into the market. But honestly, I'm still seeing a lot of doc-to-doc sales. I think there is a huge momentum and culture around being a business owner within dentistry, and I think that remains strong, whether it's listeners to this podcast or other dental students trying to get involved in how to be a small business owner. There seems to be a strong trend in ownership, and that means there is still a lot of doc-to-doc sales out there.
Yep. That leads me into our first topic point, Trey. I want to talk just what is the purchase price allocation and why is it important?
Sure, yeah. Purchase price allocation, from a legal standpoint, kind of covers a few areas for me.
Right.
So typically I see it first and foremost on the letter of intent. On the business side, the seller and buyer have different interest in lowering their tax liabilities, and so it's a negotiation point. The seller would like more allocated in goodwill, the buyer wants more allocated to equipment, and so it's always a bit of a push and pull.
Right.
On the legal side, you want to get the parties agreeing to an allocation so that if there is any sort of dispute or the IRS does want to take a second look at the transaction, that both parties are on the same page as far as what the allocations are. In fact, the documents that I negotiate, part of what we're agreeing to is, hey, when we submit filings to the IRS, this is the allocation we're agreeing to. so that the buyer's not submitting one allocation, the seller's not submitting another. It's going to avoid controversy and conflict, and most importantly, a second look from the IRS.
Gotcha. Thank you for your expertise. Omar, at Virjee Consulting, I know you deal with a lot of practice purchase conversations with clients and potential clients who are looking to buy a practice. So you also discussed a lot of the allocation. Could you kind of give us your input on what you look for from a tax perspective and why that is important?
Firstly, when we do get a potential client or a client that's looking to buy a practice and says, hey, I'd like some guidance on this. Interestingly enough, a lot of these guys that are buying practices in doc-to-doc sales where it's not highly sophisticated, right? Sometimes, aren't really getting guidance from a CPA or an attorney. So they don't even know about price allocation until I kind of bring it to the table and say, hey, have you talked about this? And they're like, well, yeah, they said some numbers and some splits, and I didn't really care as long as I'm getting it for this price. I was just trying to get the deal done. And that's where someone like Trey's expertise are highly valuable, because if you're buying a practice, please make sure you have an attorney looking over the contract and guiding in the aspect of it. Please make sure you have a CPA looking at the tax aspect of it. I'm going to say a good 40% of transactions I see, they have no idea about the allocation price. They know it was discussed, but they have no guidance on it, so they're not even, it's not even on their radar. That being said, I think it's important to take a step back and try to really explain to viewers what is price allocation. Why is it important? Price allocation, basically, the way I like to explain it is the fact that, think of the fact that you're going to Walmart and you got your basket and you're buying some hand soap and you're buying dishwashing soap and some plastic plates and this and this and this. And at the end of the day, that receipt is called a bill of sale. In that bill of sale, okay, I paid, whatever, $207, when I went to Walmart. Well, what did I pay for? And so that allocation, purchase price allocation, splits up that $207 receipt into different buckets. You paid $14 for dishwashing soap, you got some paper plates for $3.99, and that's basically what the allocation is. What did you buy? And then you take it a step further and say, think of again as departments in Walmart, right? Okay, you got the homeware department versus the toys department versus etc. Right? So same thing, the allocation price, you're bucketing things and saying, okay, my chairs, my CBCT, my etc. All that's equipment, that's gonna go in the equipment bucket. My dental supplies, the stuff that I'm leaving there, that's gonna go in this bucket. And so you're kind of bucketing things by category, itemizing almost what you're selling versus just pretty basically having one straight number to it. Why is that important? It's important because when the IRS looks at it, they say, okay, well, anything that's basically that I can touch and feel, right? I can put my hands on, I can touch, I can feel, I can pick it up, right? That is basically an asset. That's your dental equipment. That's your cabinetry, right? That's your dental chairs, right? That's even your lease home improvement thing. That's basically when you're plumbed, ops underneath, right? That's all stuff you can touch and feel, and that's an asset. And those assets can be deducted more quickly than what you can't touch. So what can you not touch? You can't touch Goodwill. What is Goodwill? Goodwill basically is the patient base, right? Yeah, you can touch the patient records, even if they're digital or whatever, right? But you can't touch the value of the patient relationship. You can't touch the value of your name in that neighborhood. You can't touch the fact that there's a non-compete in the fact that when I buy your office, I'm saying the fact that I'm not going to open a competing office within 10 miles of your radius, right? For the next 2 years, the non-compete. Those things that you cannot touch and feel is considered Goodwill. And the IRS says whatever is Goodwill will be divided over 15 years, and that amount will be you can deduct every year. So let us say the fact that Goodwill is $150,000 of that total price. Divided by 15 years makes a simple math. You can only deduct $10,000 a year. So if you bought a practice that was, let's just say $300,000 and it was $150 Goodwill and $150 asset, that $150 Goodwill, you're only going to deduct $10,000 a year. And that comes as a major surprise to most dentists who are buying a practice when they come to do their taxes, because they're like, wait a minute, no, I bought a $300,000 practice, I'm going to get a write-off, right? I wasn't expecting to pay any taxes. Well, no, you get a $10,000 write-off, and that's a big swing from a $300,000 write-off, where they're expecting the fact that $300,000 times 30%, I'm going to save $90,000 this year. This is the whole reason I bought an office, so I can pay less taxes. But really, you get $10,000 deduction, which means you save $3,000 a year. That's a massive differential, right? So it's important to understand what is asset, what is Goodwill in layman terms, and then basically say, okay, understand that the assets, depending on what deduction rules are in play at that specific year, you can deduct those assets in one shot. You may be able to deduct them over 7 years, over 3 years, over 5 years. It completely depends, right? It depends on what tax laws are being used and what strategy your CPA is using. However, it's important to get those two buckets in the right and have intelligent discussions, with your counsel, with your CPA, to make sure the fact that it makes sense. To piggyback on what Trey was saying, then comes the urge to basically say, okay, well, this makes sense. I'm going to make 95% of everything, assets and 5% goodwill. Well, that would work if the practice that you're acquiring has maybe like $50,000 in patient fees and is basically just a shell, right? And so you're not really buying any goodwill because you're buying almost a startup office, right? But if you're buying an office that has significant revenue, has a reputation, you can't do that, because when the IRS looks at it, they're going to say, okay, well, this allocation was moved in favor for tax purposes, and they're going to come back and collect those taxes from you along with penalties and interest. So it's very important to understand how it works. Try to structure your negotiations where you're getting favorable tax treatment, as long as it aligns up with the reality, and that reality is really a gray area. Like I said, you don't want to go to a direction where you have $50,000 in collections for that practice and you're saying it's 95% assets.
One other thing that we deal with, and it'd be important from a tax perspective, is the stock sale, versus asset sale. So I know you talk a lot of clients with this. It seems like a lot of times it's asset sale, but can you kind of talk about the importance of, and the tax perspective of if you do an asset sale versus a stock sale?
Great point, Humza. So an asset sale basically is let's go back to that Walmart. I've got a basket, I've got toothpaste in there, this and that, and that's an asset sale. So my practice currently has CBCT, 5 chairs, 5 offices that are plumbed. I've got cabinetry, that's a couple years old. I've got a front desk, I've got computers, and all that goes into my Walmart basket. I'm taking that basket and I'm basically putting it in front of you, right? And I'm saying, okay, I'm giving you all my assets, right? Let me take it a step further actually to make clarified that, Humza, you have an empty basket here, and that's your LLC. Now you have an empty basket. You may want to got LLC made, it's an empty basket. I have a basket that's full of like I said, toothpaste, this, that, and everything, and I'm basically taking all my stuff out of here and putting it into your LLC. That's an asset sale, and my basket is now empty. That is an asset sale, and now you've purchased, like your Walmart receipt shows, you purchased all this stuff, right? And that's in your basket now that you have a receipt for. I'm going to give you a receipt for. That's your bill of sale, right? A stock sale basically is me taking my basket, and I'm basically, you don't have a basket. I'm taking my entire basket and I'm putting it in front of you and saying, this is your basket now, right? And so when that happens, from a tax perspective, and I'm going to let you speak on a legal perspective, but on a tax perspective, what basically happens in a stock sale versus an asset sale is the fact that majority of the time, there's not any depreciation. So there's no tax benefit in buying doing this, right? Because most of the time, whoever has this basket has already fully depreciated everything, right? So the value of everything on their books is 0. And so they're moving the basket over to you, and you are continuing your books, your depreciation, everything from where they ended off at. So if the value on their books is 0, you've got nothing to depreciate because you've just taken over the entire basket, versus an asset sale. I've taken stuff out and put it to your basket, and that toothpaste, you bought it for $5, now you're going to depreciate it. This dishwashing soap for this much, you're going to depreciate it. Right. It is a itemized receipt for you, right? Why does this happen? Stock sales happen very rarely. It'll typically happen in states like New York and stuff, where setting up an LLC and moving the credentialing over is a huge burden and takes so long, right? And so that typically happens in those scenarios. It's very important to understand with a stock basis, very rarely are you going to see a tax benefit. Typically, it's a play on the fact that, hey, I want this business very quickly and I'm going to just take it over. And so you're taking over that entire business, the EIN, everything. So think of it as you have a certificate of stock for this company and you're signing over your name and handing it over to Humza. I no longer own anything. And you're basically going to take over exactly where I stopped off at and move forward with that. There's no tax benefit to that. But you are continuing the legacy of that business. Now, knowing the legal aspect of it, I know that lawyers cringe when they see that because you're taking over a lot of liability from before, and I'm just gonna let you talk about that aspect of it.
I think that's a great point. I like kind of coming at it from, you've already exhausted the tax resources. You already exhausted a lot of benefits because it's an existing business. You hit the nail on the head. I never recommend a stock sale because you are going to be purchasing, owning both the assets and all the liabilities. I'd rather have my clients own just the assets, just the good stuff. That said, it makes sense. A lot of times for partner buy-ins, they're going to buy in a minority share to a practice. They've been an associate somewhere. It's a thriving practice where 2, 3, 4 doctors can all survive and eat. but honestly, that's rare. So I do recommend an asset sale. Kind of coming just at it from the tax position, I agree. You're going to have exhausted tax benefits, and then the liability issues, the other reason. We really try to steer our clients away from that. I kind of always go back to the slip and fall example for my clients. That's what everybody understands, right? Slip and fall in the lobby. If that happened in an asset sale, a good attorney can sever that liability. That slip and fall that happened 1 week prior to closing, we can try to get you out of that. That liability will not necessarily creep over across the closing date.
Right.
In a stock sale, that's going to be really difficult. You're likely going to be having to deal with that. There's other ways to address it, indemnification and whatnot, and we won't get into that here, but it's tough.
Yeah.
Thank you both for your professional experience on that. That leads me to my last topic point. Everyone knows it's important to review your lease agreements, but what exactly should they be looking for? And what else in the purchase process should individuals look out for?
Yeah, absolutely. So leases are important aspects to every office. They live with you. They are going to be a part of your business. They are going to burden or benefit your business depending on the terms. From the seller's perspective, the lease assignment is pretty easy. We're really just looking to get them off the personal guarantee, if that's possible, get their entity released from further liability under the lease. On the buyer side, it's a totally different story. It's a major component of these sales. So as an attorney, what I do is I review the existing lease and I try to spot several areas that are going to stumble us. So a couple of them are going to be dealing with the assignment and sublease section. Of course, we are assigning a lease. We'll have to go out and likely get the landlord's consent. That's going to mean my client, the buyer, is going to send financials to the landlord. They're going to review those financials. They're going to have the ability to consent or reject. Right there, that's a risk for a buyer and a seller. They are now dependent on the landlord consenting to this assignment for the sale to even go through. We try to negotiate that. It can be difficult for a landlord, reasonably so, for a landlord to say, sure, without my consent, you can assign this lease to whomever you want. So we try to meet in the middle. We try to say, if we meet certain standards, certain criteria, net worth, number of locations, years of experience, then perhaps we can assign without the landlord's consent. But moving on from that, there are going to be a couple other areas. I recently actually came across this. There is a thing called a recapture right. So it's the same process. You go to the landlord, you request their consent for an assignment. Instead of only having two options, approving or rejecting the assignment request, the landlord in a recapture situation has a third. They can terminate your lease, take the space back from you, and theoretically just negotiate directly with the buyer. The problem is, what if they don't? All of the value in your practice could potentially go away immediately. So you really got to watch out for a recapture clause in your lease. The buyers are going to see this as a red flag and want it addressed before they even really spend much time or investment looking at the lease. You're also going to want to make sure that you've got a long amount of term left. So a lease term, right? If you have a 5, 7, 10-year lease term, let's say you want to sell in year 7, it's a 10-year term, and you have no renewal rights. The buyer is going to look at this and say, I've only got 3 years left. I need to either address this risk, right? I cannot move my practice in 3 years. That's going to risk the value of it, my investment in it. Or we need to do something with the landlord and amend the lease, revise it maybe via the lease assignment agreement to give some extension options to extend the primary term. That's going to come into, hey, how do we figure out the rent? How does this work from a cash flow perspective when I am increasing the rent beyond the initial term? There's a lot of implications from the business side about the lease. Finally, I'd like to say one other item. The exclusivity clause is usually important. A lot of people don't understand how that comes into play on a lease assignment. So you want to be, especially in a shopping center, less so in a medical office building where you don't have as much visibility, but let's just say it's in a shopping center. You want to have the exclusive to provide whatever dental service or other service you're providing. So if you're a specialist, you're the only pediatric dentist in there. You're the only orthodontist in there. You're only general dentist, whatever. The problem is that also binds the landlord. If you are a 2,000 square foot doctor and you are selling your business to another 2,000 square foot doctor, be careful. Too strong of an exclusive agreement. The landlord may want to reject that assignment request, right? They may say, hey, I've got Aspen Dental calling me every day. They want 10,000 square feet. This lease is what is prohibiting you from doing that. So it's not necessarily something you don't want to have in your lease. It's just something to be aware of. It's going to be The lease assignment agreement itself is straightforward. The dance around getting the landlord to be on board and consent, that's something that takes some skill and a little bit of thinking outside the box.
That makes a lot of sense, and it shows the importance of what you should look for in your lease, because I know a lot of times, like Omar mentioned with the allocation, people are not sure what to look for. So I think that insight helps a lot. The kind of key takeaway points that I want viewers to kind of take from our discussion today, that the purchase and sale market continues to be robust as doctors look to retire. As both these gentlemen said, the markets continue to go. We haven't seen much of a slowdown. It's important to understand the allocation and the purchase price and how that will impact you as a buyer from a tax perspective and like Trey said, from a legal perspective. And then it's important to have the purchase document, lease documents reviewed by attorney for all the matters that Trey just mentioned, to ensure that you've clearly understand the terms of your lease, these risk factors and other things like that. That's kind of the overview of today's episode. Trey, I want to thank you as a guest today for your professional input on all the topics we talked about today. It was awesome to have you on today.
Thanks for having me.
For everybody else, thank you for joining us for another episode, and we look forward to having you join us on future episodes. Thank you.
Thank you.